one of the things that really stood out to me was, the best tools, the best things. And this came across as, well, what do the best investors do? And what are the trends? And so,
what are the four commonalities among the best investors? Welcome back to Financial Success Secrets. And I brought with me again my dear friend Marci, because she's reading a book where this topic was brought up. So she mentioned that, hey, we should talk about this and shed some light upon this and share this with you guys who are listening. Hi, Marci, welcome back.
hi, Joachim. Thanks so much. It's great to be back.
Thanks. And I really love your suggestion on the topic for today and spotting these four commonalities among the best investors. By the way, what is the book that you are reading?
Oh, awesome. So yes, the book is actually called Tools of Titans by Tim Ferriss. This is a reread for me. It's a fantastic book. And as I was going through, one of the things that really stood out to me was, the best tools, the best things. And this came across as, well, what do the best investors do? And what are the trends? And so it's an interview that Tim actually had done with our good friend there, Tony Robbins. And Tony had done a ton of research and spoken to some of like the world's best investors, Warren Buffett, Ray Dalio, many, many more, and looked across all of the trends and found those four most common things. So I thought, that's fantastic. Like, why don't we share that? Let's talk about it. Let's dig in a little bit more and find out and see what else maybe, if we have some examples that you might be able to share with people and such. So yeah, let's, if you're ready, I say we dig right in.
Yeah, that is amazing. These are some of the best investor, most wealthy people on the planet as well. So yeah, there are some gold nuggets there. So I'm looking forward to share this with you. What is the first commonality that Tim Ferriss brings up?
Sure. So the very first commonality is capping the downside. And really sort of, when there's a point when maybe things aren't going as well, at what point do you stop and reevaluate or stop and change strategies? And for investing, I thought you might be able to shed some light on this of, talk a little bit more like around that, or what a good example of that might be.
Yeah. So eye-catching secrets. Yeah, I practice long-term investing, and this is also a key principle there. And I know Tim Ferriss briefly mentioned this as well among these points. Now, okay, capping the downside, stopping the loss. What does that like really mean? And first and foremost, for investing, that process starts actually before you do any investing at all. It comes back to understanding what you invest in. And I know it's mentioned in the book with Sir Richard Branson asking like, what is the downside? And that is a great question, because it can be really easy to find all the reasons why we should invest. Like, we can get excited. Maybe people talk about it. We heard something great about if it's a company that we're going to invest in, or maybe a friend shared something about a crypto, whatever it is. So it can be really easy to get excited and yes, like kind of put my money in there. It sounds good, but flipping that around and asking, yeah, like, can this go to zero? It's a very important thing to ask ourselves. What is the one reason we shouldn't invest? Because that will bring some clarity on what is the risk that you actually are accepting. So it's all about understanding what we are investing in. And for long-term investing as well, part of that understanding what we are investing in would also be the fees aspect, because fees can really eat up your funds or like your returns. And it's huge. It's huge. Like, and many people are, for example, offer to invest on a regular basis, for example, in a pension fund. Maybe you're familiar with this, Marci. Like every month, yeah. And for like some of these funds, people have to charge 2%, and you might say like 2%, it's nothing. I get to keep 98. Like, what is the deal? 2%, nothing. But the thing is that in the long term, like, that percentage gonna eat up huge amounts of your returns. Like it could eat up to 60% of the money like that was intended to be given back to you. And I saw this example, and it affects just even small percentages as well. And I saw that, for example, just on my mortgage. Some while ago, I renegotiated the interest rate, and I got it down from 1.69 to 1.29. So it's a 0.4 difference. Does that really matter? 0.4? It's like, it sounds like nothing, right? But it turned out that over the course of the entire loan period, I was actually, excuse me, I was actually going to save about 10% of the money that I borrowed. So 0.4% would turn out to 10%. So what does it mean? Like if I borrowed 300,000, it actually saved me 30,000 in interest over this period, over 20 years. That's quite an amount of money. It's an extra vacation every year. So it's huge. That is, so in long-term investing, cutting the losses, that stops even before you start investing.
I love that. That is a really brilliant approach to something where, mitigating the damage before you even start something and really digging in, making sure that you're knowledgeable, making sure that, you understand the processes and what's going on before you jump into something. I think that absolutely is a great thing about, how capping that downside. And I really like the mortgage example that you brought up, because people don't realize that, oh, it's just a tiny bit of a percentage, but I think knowing your numbers is really important on that front. And if you don't, then that, that's already like a potential risk that you may have not even thought of.
Yeah.
Awesome.
So, yeah. So that that explains that explains why the financial industry has rigged the game, because with us paying fees and even small percentages, they earn massive sums. So knowing your numbers, educating yourself, it's huge. It will save your pension.
Absolutely.
To sum that up, Tony Robbins summarizes it really well. Like for every 1% in fee that you pay, you give away 10 years of pension income.
Wow.
Just to give our frame of reference.
To know your numbers.
Yeah.
Awesome. So the second one that we have on our list of commonalities across the best investors is asymmetrical risks and rewards. And the best investors really, you may think that they say, okay, I'm going to bet this huge amount of money and it's going to be a huge reward. But honestly, what a lot of the best investors do is look at something and say, okay, what if I put up a little bit of risk and then I got maybe 5 times the amount of reward back? Or what's the potential? Okay, here's what I'm investing, and then here's what I'm likely to get back. Actually, I think Jay Abraham had a really wonderful story he told once. I don't remember all the details, but it was where he was able to leverage something. So he actually had some videotapes, or someone had some videotapes that for a business that they were able to get this company to get the videotapes for like, I don't know, let's say $1. And then they went to like a convenience store and said, hey, you've got some extra counter space here. What if I put this, box of these, cassette tapes at the time, so this might be a little dated, and for every single one that sells, I'll give you $1. And, you didn't have to really do anything else. You're right there at the checkout. They said, sure. And so all of a sudden, you've got these sales coming in. You didn't have to do all this marketing and everything. You're paying them, the convenience store, you're paying the company for, the tapes, and they already had these tapes, I guess, that were sitting around, not selling, not doing anything anyways. And so you're able to get them really cheap. And then if you sell them for $5, pop, then you're making this profit, and being able to, have little to no risk to do that was absolutely amazing, and was able to be leveraged for that. So that's maybe a business example of it, but do you want to talk about maybe an example of that in investing?
Yeah, fantastic example. Exactly. It's about mastering low risk, high reward returns, or low risk investing, high reward investing. And in terms of long-term investing, we actually preempted this, and it comes back to knowing what we are investing in. Now we could deep a little bit deeper, and when looking at investment opportunities, there are, for example, we can look at, is the company now actually undervalued or overvalued? Like, what is the price? And for example, when the pandemic became a fact, that what happened then is a lot of people without much experience, a lot of like normal people, let's call them, like, yeah, and anybody started, or a lot more people started investing into the stock market, not having much experience before, never doing it before, but they heard like, this is a great opportunity. So what happened is that, okay, when the pandemic became a fact, the prices of stocks really plummeted. It really went
Yeah.
down. But shortly after, it didn't take much long time, like a month or 1.5 month, then we saw, okay, prices start going up again, and they went up massively. What happened is that now it's actually very usual that companies are overvalued because there have been so many people coming and investing, putting so much money, and not having so much of these concepts that like the titans have applied for themselves, but they just buy because I heard it's an opportunity. And for most that invested during the pandemic, it turned out really well. Like, even if you invested on the worst day, like the day before the pandemic, like late February, at the high before it went down, you will still make massive profits. Now, I'm not saying that that is a great strategy, investing when prices are going up, up, up. I can talk a little bit more about that later. But the point is, now with so many people doing investing, it's actually become a common theme that companies are overvalued, and that you're paying according to like the analysis of the company. Like, would this give you a profit in the long term? Like, would this be a profitable investment? Then, okay, it's becoming actually quite common that you're paying quite much, like you're paying a high multiple of the share price, of the stock price, compared to like what that is projected to give back.
Hmm.
So it's something to understand. It comes back to understanding what you invest in, and yeah, looking at some key factors and understanding this, that yeah, some of these like fundamentals, as we call them, like looking into the factors of the company, that that is really what's going to determining whether that company is most likely to yield, or yeah, to give you the returns that you're looking for. But it changes over time as well. Now, another thing I would like to mention is, okay, with all the uncertainty going on right now, with the war in Europe, in Ukraine, and stocks be falling again, when that happens, I look at that as a great sale. And one frame to that is, okay, because prices have been higher in the past, so investors have been actually willing to pay a higher price in the past. So it's likely that the price is going to go back up there. And when it comes to investing in stocks, that is companies, or you might know it as shares. Stocks and shares are basically the same. It is that these companies that we invested, they want to deliver value. And you and I, as consumers, we want a better lifestyle. So with this race of providing better services, better quality, and you and I, we are most likely willing to pay for that. Or we want the next phone, we want the next gadget, we want a better lifestyle, we want to go travel, we want to have experiences. So there is this development all the time, and we have the history. The stock market, the share market, been going up, 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 up. Yes, there are some downturns on the way, but overall, it's all about advancing technologically, increasing the lifestyle. But then, yeah, understanding what you invest in would be key. Did this give some clarity?
It did. Yeah, absolutely. That makes a lot of sense. And really, I guess to add to that, looking at the patterns of the past and looking at that data and seeing like, okay, there's always been times of uncertainty. There will always be times where there's, more uncertainty. But when we're able to look and, understand, okay, well, this is what happened before, let's use that as a, some framework to be able to bring forward to say, okay, well, maybe now it's going down, but there's definitely data to prove what goes down will come back up. And yeah, so thanks so much for your points on that, and to really clarify, yeah, risks versus the rewards on that. The
Yeah.
third one that we have is asset allocation. And I think they actually had mentioned in the book in regards to asset allocation, that the best investors assume that they are going to be wrong. And I thought that was really intriguing. Okay, well, that's a different mindset maybe than many people have when they go into investing. And I talked about that, assuming they were going to be wrong, because oftentimes that does happen. And by accounting for that and by diversifying their portfolio, diversifying their assets, then when they were wrong, it cost them a lot less. So they almost anticipated that. So you want to share a little bit more about why that's so important and any other thoughts you might have on it?
Yeah, assuming that you will be wrong. Like, sorry, that could be a great expectation setting for yourself. Yeah, assuming that you are going to be wrong. And what that could do to the mindset as well is, especially for long-term investing, is that we're willing to see that the price of our investment goes down. And if we go back to the previous points, when we have done our research, when we know what we invest in, when we invest in something solid, then we know that, okay, there might be some temporary news. Let's say there's a war going on, so a lot of people become fearful, prices goes down, but we know that we invested in something solid. When people see that, okay, the world is going to survive, prices will go up. So having this expectation as well for long-term investing that, okay, the price is going to drop, it can help us make more profits, because then we can apply something known as cost averaging. And that is when prices drop, that we actually continue investing, because it's going to push your average price down. So that is in terms of asset allocation as well. Like it includes money management. We could include that here with, when you pick your investment, that you don't invest all your money at once in the particular investments, but you spread them out as well, being prepared that the price might drop. And then asset allocation as well was really huge, is that we don't put all our eggs into the same basket. So for example, if we invest in stocks, in shares, that is companies, that you don't put all the money into the same company. That you might have fallen in love with one particular investment, but yeah, if that company goes bankrupt, you lost it all. And then we can take a higher level view. Like it's a good idea to consider to not put all your money into the stock market, into shares, but there are other asset classes, hence asset allocation. For example, commodities, precious metals, there are crypto, there are real estate. These are different asset classes. And the idea is to invest in something that is not correlated. So it doesn't really help to invest so an example is it doesn't really help to invest in an oil company and you also buy oil, because if the price of oil drops, what happens to the value of the oil company? They are most likely linked. So that we have that in mind, that we diversify is what we want to do proper asset allocation. Because as you said, these titans, the best investors, they assume they're gonna be wrong. And the thing I had a thing on my mind, and it's gonna come back in a moment. It's gonna come back.
I like what you said about the not putting all of your eggs in one basket.
Yeah.
I think that's so true for investing, for crypto. Also, I think in life too, just to make sure that you're diversified and not banking on the one thing in order for to achieve your goal or to achieve success. So
it came back to my mind right now. And
awesome.
Yes. And Warren Buffett is an advocate of this. And that is the most important thing you can do as an investor, is protecting your money. And that is what asset allocation is. That is what risk management is. It's all about protecting your money. That's the most important thing you can do as an investor.
Yeah, absolutely. To make sure that you're protecting what you have, and not what's the term that some people use, the betting the farm of, okay, no, we want to protect the farm. We want to continue to have things grow so we can build a better, bigger farm without losing it all. And doing that with smart strategies, knowing what we're investing in, and then really diversifying. The final one for the final commonality that all of these investors had in was they all were very, very big on contribution. So giving back, donating to charities, and really like paying that forward and focusing on something that was really meaningful to them, and that they wanted to make a difference on in the world. I also think that that is really important, no matter how we're investing, that investing that back into the world, into the planet, into people, and whatever causes that we're passionate about. Do you have any other thoughts on that?
I can share that I had the pleasure of, for example, buying food to families less fortunate than myself here where I live in Oslo, Norway. And it is an amazing experience to see what kind of impact it has for these families. How they can, something that is so simple for at least me to do. And I take it for granted every day that I have food, but these families don't necessarily take that for granted. To seeing the impact it can have, giving back, it can help us getting some contrast on life as well and practice appreciation. And it's not to feel important in any way or to get someone to pat yourself on the shoulder. It just know for yourself that you made a difference and you can help people give back. It's like happiness is a community feeling.
Yeah, absolutely. I love that. Happiness is a community feeling.
Yeah,
it's great. It brings it, because it's not just about happiness for us too. I think one of the things that I've seen make individuals happy is in fact bringing that happiness, bringing that joy, and giving that to other people. And oftentimes I think that we will do more for others than we will even do for ourselves, and that plays into it as well. So yeah, this has been great. Do you want me to go ahead and recap the 4 things?
Yeah, please. That would be awesome. And then we wrap it up with our catching move. So please.
Awesome. Cool. So today we have to talk about the 4 commonalities across the best investors in the world. And the first one is capping the downside. The second is asymmetrical risks and rewards. We talked about asset allocation, not keeping all of your eggs in one basket, and contribution, to make sure that you're also getting fulfillment from investing. Do you have anything else to add?
No, that's well summarized. And Marci, it's been awesome. Keep up reading awesome books. And
Absolutely.
I would love
stop
to
me
hear,
if you tried.
I'd love to hear about more insights you're able to pull out of these titans of successful people who have walked the path ahead of us. So thank you very much. I'm not sure have you joined our catching move before we do this?
I think we did this last time. I was getting there. I just got to work on my timing.
Fantastic. So let's do it. Our arm up and we say catching.
Catching.
Awesome. Stay happy, stay safe. See you guys. Bye.
Please be aware, we are no financial advisors. We do not provide any advice. We only share our experience and our results are not typical. If we mention any stocks, funds and other type of investments, it is for educational and illustrational purposes only. Most people are unable to achieve similar results to ours. If you want to achieve similar results, you have to commit yourself to systemize, to learn and to stick to the rules.